Now, which of the following are true about inflation index bonds? This was asked in 2021 prelims, I think, detailed question. And if you had studied from our test series, those students of those years, they could have solved it. Okay, so it protects both capital and interest of investors. This is actually true. They are sovereign bonds issued by the government of India. That is also true. Its predecessor was capital indexed bonds, CIB, issued during 1997, which provided inflation protection only to interest payment and not to principal. This is actually reverse. A capital index bond gave protection to principal, okay, but not to interest payment. That was the predecessor, the first thing, capital index bond. Now we have inflation index bond, which will protect both the capital and interest. Okay, so basically, as I told, it's a sovereign one issued by the government of India, and it provides the investors a constant return irrespective of the level of inflation. Okay, because ideally, you invest your money. Suppose you put your money in a fixed deposit or something. You put your money, they will take and do something, whatever they like, the bank people. And later when you go and get it, you will not get any inflation benefit out of it, because inflation means the money will become less value when the time goes. Okay, like in the 1980s, if you give 1 rupee, you will get like 1 kilo rice or something. Now you won't get that. Now you need, because money's value has gone down. Okay, so that is the inflation, money's value going down. So level of inflation, when it changes, your bond, what you have invested, that also returns also changes. That is the benefit of inflation index bond. Okay, constant return irrespective of the level of inflation in the economy. The main objective of inflation index bond is to provide a hedge and to safeguard the investor against macroeconomic risk in an economy. Issue of IIBs has assumed significance in the context of high level of inflation experienced in the emerging market and developing economies during the recent years. So now inflation rises there everywhere. So the bonds also. So here a typical example, okay, with like suppose how much you invested in each year, like that example was there in newspaper, so I just took it. Okay, so like first year, suppose your principal was 1,000 rupees. Okay, inflation in the economy is 3%. So there is an inflation accrual calculated. Okay, meaning 3% of this thing, that is 30 rupees. So instead of considering your principal as 1,000, they will consider your principal as 1,030 now. Okay, because they are calculating inflation also. You should get the benefit of inflation also. Okay, so promised rate of return will be there, right? The interest rate. Interest rate is 3%. So instead of calculating 3% on your principal of 1,000 rupees, they will calculate it on the inflation adjusted principal of 1,030 rupees. So you will get 31 rupees extra interest. Okay, so 30 of inflation you got here and 31 of interest you got here. So 61 rupees benefit you got. Okay, so next here when you consider again the second year, you will not consider 1,000 rupees as your principal. You will consider 1,030 as your principal. Okay, then inflation in the economy, suppose it's 6%. The same calculation is being done here. Okay, principal at the end of second year, the inflation accrual you are calculating, the promised interest you are calculating on top of that one. Okay, on top of the inflation adjusted one, and then finally you will get so extra 94. So like this, each year a compounding will happen and you will earn. Okay, this is not 103, it's actually 1,030. Okay, that's what I am written here, 1,030 in column 2. It's a printing mistake. Okay, so it is 1,030. So you have some money, but instead of calculating interest on that, they will calculate on your inflation adjusted principal. So you will get more returns. Okay, that is the logic behind inflation indexed bond. So now this is the theory or GK part of it. Like it was first announced in 2013 budget. Anyone can invest in this bond, but they are distributed in such a way that institutional investors such as LIC mutual funds, right, they will have to receive 80% of the bond and retail investors receive 20%. So anybody can invest, but it will be like limited. Only few people will get it. The first come first serve kind of thing. 80% will be gone to these people. Remaining 20% you will get it. These bonds are auctioned directly by the RBI, but the government obviously will receive the money. Okay, because RBI is government's bank only. So government will get the money. Minimum and maximum investment amounts are 10,000 and 25 lakh respectively. These bonds can be redeemed after 10 years or else a penalty will be imposed. So for 10 years, you will be investing in the bond. These bonds can be traded in the secondary market. Okay. And through this BSE, meaning Bombay Stock Exchange, National Stock Exchange, anywhere you can trade this bond paper which you have. Okay. And obviously that time tax has to be paid. So don't think it is tax free or something. Okay. Capital gains tax will be there on the dividend or the extra thing which you earn. Okay. So it provides a continuous return to investors regardless of the amount of inflation. That is the main benefit. Okay. The real coupon interest rate on this IIB is fixed, but the nominal principal value is adjusted for inflation. I showed you example. The principal is adjusted. Government can reduce the coupon rate and adjust. That is what they can do. The principal will keep getting added. Interest rate government controls and they will maybe changes instead of 3%, 5%, 6%. As I told, they will keep changing. On the modified principal value, periodic coupon payments will be issued. In this way, both the principal and the coupon payment will be protected from inflation. Okay. So both are protected from inflation. When the bond matures, the adjusted principal or face value, whichever is greater, will be paid. Okay, mature means after the 10 years, your this thing, whichever is greater, right, your adjusted thing, obviously that bigger one, that you will get it. IIBs are classified as government securities, GSEC, and hence qualify for repo transaction as well as SLR. Okay, this is like basics again. Economic test number 1 I taught you. Banks have to keep certain money. Okay, banks have to keep certain money in the form of SLR, like it will be like 22% and all. And after that, remaining only they can give out as a loan. Okay, so SLR means you can keep in the form of cash, you can keep in the form of gold, you can keep in the form of government security. So they are telling this inflation index bond are actually qualified as government security. So this you can use as their SLR. Okay, in case if you have it. And in the repo also, repo means what? Repurchase option, meaning when a small bank wants money from RBI, what they will do? They will ask for money. Okay, so RBI will tell, give me some security. That time they are telling this is qualified as a security. So okay, you can give IIBs. Give IIB to RBI, RBI will give you money. And later when you give back the money, you can repurchase that. That is called repo. Okay, so this is again qualified. Now IIBs assist the small investor in protecting even the principal amount against inflation, in addition to obtaining the investment yield, which is dependent on the current inflation. So again, same thing they're telling, protecting the principal and the interest. Okay, it is also predicted to enhance domestic savings and reverse the savings to GDP ratios downward trend. Okay, savings to GDP ratio was going downward. So it's telling this kind of thing, this kind of IIBs and all, it will help people to save more, earn more, and it will reverse this slowdown. Okay, so that is the overall GK, and this is the maximum I think any coaching class can teach you. Okay, I have taken it from various sources. It's not taken from a single book or single place. Okay, it's from different sources. So if you study this way properly, inflation index bond, next time anything comes, you can answer it. Okay,